Okay, very good. Well, it's my real honor to welcome Bill Bruss, the president of Waterstone, but also the CEO-elect. So it's great to get to know you, better. Appreciate the opportunity. So Waterstone Financial, ticker WSBF, it's a Wisconsin-based thrift with two segments, community banking segment and a national mortgage platform. So we look forward to your discussion of Waterstone's franchise, the dual franchise, and also some of your insights. And if you could please make sure to tell us about yourself and your history in banking with Waterstone too, because we're thrilled to have you here. I'm going to get your slides up maybe while you talk about yourself, if that's okay.
Sure. The first few slides in our deck really provide a general overview of our consolidated business, which, as Julianne mentioned, consists of two distinct lines of business. Our community banking business, which has a 14 branch network in and around the greater Milwaukee area. And second, our mortgage banking business, which is operated as a subsidiary of the bank, has offices in over 25 states, and the ability to lend in all states except for Alaska and New York. If we could jump to slide 6, that'll give me an opportunity to introduce our management team. I think we're fortunate to have a strong executive team that really brings a diversity of experience and skills to the table. As Julianne mentioned, I am currently the president of both Waterstone Bank and our holding company, Waterstone Financial. I am, by education and practice for a good number of years, an attorney. I spent 3 years in private practice, including being part of a team that effectively served as Waterstone Bank's general counsel. I joined the bank in 1997 as its in-house counsel. At the time, we were a 3-branch mutual savings bank with around $450 million in assets. As the bank has grown, effectively quadrupling in size, I've had progressively broader experience, ultimately with responsibility for all operational areas of the bank. My background in credit has been significantly formed through our experience with asset quality issues during the Great Recession. That was kind of a process of identifying the issues that created the more significant problems for us and how to avoid those on a go-forward basis. And subsequently, as a member of our loan committee, I added some additional management responsibilities in 2022 and 2023 after being appointed to my current role in January of 2022. In July of this year, Doug Gordon announced his retirement as CEO of both the holding company and the bank, effective at the end of this year, after holding that role for the past 16 years and being with the bank for the past 18. I was also, as Julianne mentioned, announced as his successor. Doug is a great banker and a very good leader. And I think both I and the entirety of our management team has benefited significantly from his leadership over the past 18 years. As I was preparing for this, I got to think about the culture that has been built and developed under Doug. And there are a few things that stand out to me as core to who we are as a bank and critical to our ongoing success. First and foremost, I would highlight credit discipline. We've developed a very strong and disciplined credit culture that that is reflected in asset quality metrics over the last 10 years, and we'll touch on those a little bit further along. The second would be deploying capital in a way that benefits shareholders, builds shareholder value, and still maintains healthy capital levels. And third is really profitable and organic growth, which is to say that we have consciously chosen not to grow simply for the sake of growth, but when the market allows us to do so profitably. And I think I'll have the opportunity to touch on a couple of areas where that could be highlighted as we go through the presentation. Doug and I have certainly different styles. I may do some things differently tactically, but we are very much philosophically and strategically aligned. And both I and our management team will continue to really be focused on those core items that I identified earlier as we move forward. In addition, Doug's not disappearing when he retires at the end of this year. Doug is going to remain on the boards of the holding company, the bank, and the mortgage company, and has offered, to me to be available as a resource and something I plan to take advantage of as we move forward. If we could move to slide 7. In 2005, we converted to the mutual holding company structure and subsequently became a fully publicly traded company in 2014 with the completion of our second step conversion. Our strategic objectives, as I touched on a little bit already, revolve around capital deployment, asset and liability growth and optimization, and our mortgage banking business. And I'll touch on each of these in greater detail throughout the presentation. Moving to slide 8. There are a few items on this slide which really is just a summary of our consolidated financial performance over the last 4+ years. But the things that jumped out to me on this slide are the mortgage banking impact. When that business is really, really good, as it was in 2021, we significantly outperform. And when that business struggles, as it has the last 2 years, it really does cause some stress on the overall consolidated performance. Significantly, there's greater earnings volatility in the mortgage business than there is in the community bank. But the mortgage business has been a strong overall contributor to the company since we acquired that business in 2006. The next item I wanted to highlight is our return on adjusted average equity. That's a metric that assumes the distribution of a special dividend to reduce our equity to 10%, and further assumes a cost of borrowing to pay that dividend at 5.5%. But I think what that metric highlights is a much more a return on equity that more relates to peer than it does when you include our current equity levels. And the last item I wanted to highlight was just price to tangible book. We've seen the market price decline fairly significantly through the course of 2023, resulting in a price to tangible book right now of about 66%. If we could move on to the next slide. This slide highlights our return to shareholders over the last 4+ years through a mix of dividends and share repurchases. We have returned over $265 million to shareholders from 2019 through the third quarter of 2023. with special dividends paid in 2017 through 2021, as we saw stronger performance in the mortgage segment. I think to me, the most significant aspect of this slide is really the second chart, which reflects not only, which reflects our ability to return capital to shareholders at a very robust level while continuing to grow book value. That green line represents tangible book value with the AOCI added back in, which I think is a fairly fair view of the growth of book value over the last 4.5 years. The next slide is just a quick overview of the community bank. We're a $2.2 billion asset bank, 14 branches in the greater Milwaukee area. Loan book of $1.65 billion, core deposits and total deposits of 73%. Current efficiency ratio at 55%. And again, total capital ratio at over 15% and risk-based capital approaching 20%. Looking at slide 11, the items I wanted to highlight here were really the growth in transaction deposits between 2019 and 2022. I will touch on that a little bit more in a couple of slides. From a earnings perspective, obviously we're showing some significant contraction in the net interest margin from year-end 2022 through the third quarter of this year. Our efficiency ratio elevated by our standards in 2022 and 2023 as we've seen that net interest margin compress. But I think that's a number that generally reflects our commitment to expense management, including our ability to gather deposits with, I think, significantly less brick and mortar and headcount than most other $2 billion asset banks. If we can move to the next slide, this just highlights our branch footprint and the 3 branches that we added in 2019 and 2020. Those 3 branches really filled in our network in the southern part of our market. And you can see if you look towards the northern and western part of our market on the map that we have, more significant geographical gaps between branch locations in those market segments. Any future branching activity would most likely focus around infilling in the northern and western parts of our market. But the other major factor in future branching activity, I think, is weighing the value of additional brick and mortar versus additional investments in technology. Moving on to slide 13, we continue to believe that we have opportunities to grow our market share of deposits, particularly by differentiating ourselves from the larger national and regional banks in our market through our service to sales model and community involvement. Just touching briefly on our community involvement, we typically contribute around $700,000 per year through our foundation to a pretty wide variety of not-for-profits that are generally focused on education, families, and veterans initiatives. And we have really strong employee volunteerism with those organizations that we do support financially. Anecdotally, what we saw during COVID was that we were able to attract some new relationships from the larger national and regional banks in our market, as they kind of chose to turn their back on some of those small businesses who were looking for relief and participation in government relief funds. And so, again, highlighting what we think is our opportunity in our market. If we can move to the next slide, we're going to continue to emphasize improving our core funding, both in balances and mix of deposits. Thinking back to slide 11, we grew transaction deposits, including lower yielding interest-bearing transaction deposits from year-end 2019 to year-end 2022 by about $300 million. That illustrates both the challenge and the opportunity of moving from a typical thrift institution to a more commercial-like bank. While we've seen a $90 million reduction in transaction deposits this year, as some of those dollars have flowed into time deposits or alternative investments outside of the bank, we've actually had small but positive deposit growth through the third quarter. And again, we're going to continue to have an ongoing focus on growing and diversifying our deposit book. On the lending side, on the next slide, we have grown loans $200 million since year-end 2018, with growth in commercial real estate, including multifamily and 1 to 4 family mortgage loans leading the way. Just kind of sidetracking here for a minute, you can see in 2021 where our total loan portfolio actually shrank. And when I mentioned earlier this concept of not growing for the sake of growth, that was a year when we had no issues originating new loans at rates that we were comfortable with. But we were impacted by a lot of refinance activity at rates that we simply chose not to match. So there was a lot of pricing discipline that occurred in 2021 that, was really looking towards longer term profitability versus short-term profitability and potential pain down the road with those lower rate assets on the books. 43% of our loan book is concentrated in multifamily, with another 34% in 1 to 4 family mortgages. With total bank capital at around $314 million, we retain capacity to grow all of our lending segments, including multifamily. Multifamily is really both a strength and a niche for us, and has been a strong performer for a number of years. When I look at our multifamily lending, I think of it as bread and butter multifamily with typical deal size in the $1 to $5 million range. Our collateral, without ignoring our obligations under the Community Reinvestment Act, is generally located in suburban or ex-urban areas with strong demographic profiles. And we generally avoid the very high-end multifamily that typically is going to require rents at the very top of the market and ultimately pose a greater vacancy and cash flow risk. And when you look at our portfolio, I think the opportunity that jumps out is the opportunity for growth in our C&I loan book. If we can get some traction there, grow that book, we're going to benefit not only the loan portfolio, but also our funding mix and our cost of funds. The next slide reflects our commitment to credit quality coming out of the Great Recession. I think these 4 different charts really kind of speak for themselves, with current delinquency and non-accrual rates running at 0.5% or less, negligible real estate owned, and total non-performing assets under $5 million. We're going to jump now to the mortgage segment. The next couple of slides provide some general information regarding our mortgage business and its leadership team. I already highlighted on how we're geographically able to lend in almost every state in the country. offices in 25 or 27 different states. And again, a very well experienced leadership team. Excuse me. If we could move to slide 20, oh, we're right there. We have a 4+ year look back at financial performance. Lines 2 and 5 on this chart provide a summary of the challenges that our mortgage business and also the industry in general are facing. You see a significant drop off in loan origination volumes, coupled with a 100 basis point drop in gain on sale margin. Those are the two single greatest factors that are driving the drop in financial performance in that business segment. The high mortgage rate environment has effectively eliminated the refinance market and dramatically impacted home sales. Something like 70% of homeowners with a first lien mortgage currently have a rate of 4% or better, greatly reducing the incentive for homeowners to sell their existing home and purchase that new home even at the same value, when that mortgage rate that they might step into could be double their current rate. Gain on sale margins tend to move with loan origination volume. So as volumes have dropped, so have those margins. We would like to see, as volumes, when and if volumes increase, that those margins will come back in and we'll get that business to return to a more normalized level of profitability. If it's okay, I'd like to jump around just a little bit and talk about the overall strategy in the mortgage business and how that business is being managed in the current environment. Slide 23, that's perfect. We can see how our mortgage business emphasizes originating purchase money mortgages and consistently does so at a level higher than the broader market. That focus was typically going to provide for more consistent and profitable business. I like to think of purchase money mortgage origination as the consistent and constant strategy in our mortgage segment, with refinance originations enhancing that business when the market presents those opportunities. Even in 2020 and 21, where refinances were a significantly greater part of our mortgage business, that business was still growing purchase money mortgages year over year. If we can jump ahead another 4 slides to slide 27, this slide really details how the mortgage business supports their primary focus on purchase money originations and what it enables them to outperform the broader market in that regard. In short, it's really about minimizing the number of days from borrower application to closing. There's a lot of factors that feed into that, but it's making sure that those purchase money deals close on the borrower's timeline, not our timeline, which really helps us attract and maintain realtor relationships, which are critical to perpetuating that purchase money origination focus. Jumping back to slide 25, this slide gives us a view at some of the expense management that has been implemented during the declining volume environment. They've reduced overall headcount since 2021 by 134, administrative headcount by 158 during that same time frame, but actually grew the number of loan originators by 24, excuse me. The objective there is to make sure that the company is both managing expense effectively, but also positioning itself to take advantage when mortgage volumes return. And there's a point of sensitivity in the admin staffing where you can cut that too thin and not be able to refill to support the purchase money business. And so it's a constant balancing act, monitoring and managing the staffing to loan volumes. On the next slide, we kind of eliminate 2020 and 20 through 2023, which, really represent extremes in both ways, in both volume and margin. The 10-year period between 2009 and 2019 produced net income at approximately 35 basis points of loan origination volumes. If you assume normalized volumes in that business segment of $2.5 to $3 billion, a net return of 35 basis points would result in net income in that segment of $8.5 to $10 million. And I think, more than anything, that gives you an idea of where we want to get that business back to. We have had really 4 years of sort of outlier volume and margin environment. The goal is to get back to that more normalized volume and margin environment and return earnings in that segment to an appropriate level. If we can jump to the last slide, that's just slide 28. Thank you. That's really just a summary of MBA projections and actual market activity over the last several years, as well as a forecast into 24, 25, and 26. We can see, the MBA projecting some increase in volume in each of the next 3 years. Certainly nowhere near a return to the 2020-21 levels, but by 26, certainly approaching a more normalized volume of mortgage activity. And that is, the end of my formal presentation. And I understand we'll have some time for questions.
Great. Yes. Well, I see a number of questions. While I'm kind of queuing those up, Bill, can you talk about the recent Wisconsin state tax law change? Can you?
Sure. In August of this year, when the governor signed the new budget law into effect, that budget contained a provision that would, as it's drafted, eliminate state income tax on commercial loans less than $5 million. And we've seen some banks in our market start to adopt that change. We think there's a lot of variables in it that have yet to be clearly defined, and so we have not implemented that. It's not entirely clear, for example, whether that law covers commercial real estate. If it does cover commercial real estate, does it include multifamily? Is that $5 million threshold at the time of origination? Would it include at the time of renewal, or at the time that loan naturally amortizes to that level? So those are the things we're looking to our Wisconsin Department of Revenue for some clarification on. But there will be a positive impact for the community bank. We just can't clearly identify how much that impact may be.
Okay, well, positive on the margin, though. Definitely, positive development. We have some questions about the mortgage business.
Sure.
Have you cut as much as you can by this point? Have you cut it to the core?
The short answer is no. We think that right now we've cut commensurate with volumes where they're at today. They measure and monitor, volumes really on a daily basis. And there's the ability to further reduce headcount if there's sufficient reduction in volume going forward.
Well, given the forecast that you showed from the Mortgage Bankers Association, when would the mortgage break even, your mortgage business, just given those forecasts?
In the forecast, I think it's I think we're likely to see a return to profitability on a quarterly basis, potentially by the end of next year.
Okay. Okay, and then
there's so much. I'm a little hesitant on that because
Sure.
there's so much variability there that it's very, very hard to peg what that inflection point is. So I want to be really, really cautious with that. But if the volume comes back, as it comes back, we should see any loss reduce and hopefully get to a break even or better.
Okay. All right. And there was a question about net interest margin, for the community bank. If rates really do stabilize from here, what do you see? Do you see the net interest margin inflecting? Starting to stabilize too? And about how many quarters?
I think stabilization first. We
Okay.
did have really into the early second quarter a fair number of time deposits that will reprice. So even if rates are held at current levels, we're going to see some increase in interest expense. We will continue through that same time period to, of course, reprice existing loans in our portfolio and originate new loans at a higher rate. So I would expect to see interest expense, really stabilize early second quarter. The other big variability there, of course, we have, a lot of funding through the FHLB and the Fed at this point in time. That's really supported our loan growth through this year. But, if we get activity in the mortgage segment, it's very likely that we'll see refinance activity in our 1 to 4 family portfolio, which is going to provide additional liquidity and reduce our utilization of that FHLB and Fed funding, which again would have a positive impact on margin.
Okay. And then we had a question about the credit unions in Wisconsin. This,
Can I use 4-letter words on that?
There's a lot of, and they've been acquiring banks. And so question, how do you cross paths with credit unions at all?
We do. We see them as certainly competition on the deposit side. We've seen them increase their activity in the commercial lending areas as well. Their competition on the employment and staffing side, and there's certainly competition in the M&A market. They, when you're acquiring with after-tax dollars, and every other bank is acquiring with pre-tax dollars, that's a significant differentiator and an advantage for them. And they've been active in this market. I think the largest transaction is maybe a commercial bank just in that $750 million asset range. But typically significantly smaller than that.
Do they get into multifamily? Do you see them in the multifamily sector?
We do.
You do. Okay.
Yep.
Right. So potential. All right. Very good. Well, I think I think we got to most of the questions. Make sure to circle back if not. But thank you so much. It was such a pleasure to.
Thank you. I greatly appreciate the opportunity and hope to do it again.
Very good. Thank you so much.
Thank you.
Thank you.